Welcome to accounting. Let's begin by mentioning that there are three types of organizations. A sole proprietorship is a business owned and operated by an individual. A partnership is when we have two or more owners. And a corporation is a separate entity owned by the stockholders. In this course, we cover the accounting for a corporation. Once you learn accounting for a corporation, it is easy to understand the other two. Let's start by visualizing what is happening in our business. We have numerous business transactions that occur. We make a sale for cash. We make a sale on credit. We buy inventory. We pay wages, etc., etc. We must analyze and summarize the transactions so we know what is happening and if we made or lost money. This is what accounting does. The transactions are analyzed as to if we should record them at all, and if we do, what are they? They go through an accounting system that records and summarizes these transactions and produces reports. These reports are known as the financial statements. A complete set of financial statements consists of four separate reports. 1, the balance sheet. 2, the income statement. 3, the statement of retained earnings. And 4, the statement of cash flows. You need all four to get a clear picture of your company, as each one shows it from a separate view. This is the first building block of accounting, the accounting elements. All transactions are classified into 6 broad categories or elements. The first is assets. Assets are things of value that you own. Next is liabilities. Liabilities is what you owe. Stockholders' equity is how much you own. This is the difference between your assets and your liabilities. For example, if you have a car that cost $10,000 and you owe $8,000 on it, which is your liability, your amount of ownership, which we call equity, is $2,000. Then we have revenue, which is how much you earn, and expenses, the cost of doing business. And finally, we have dividends. Dividends is an oddball. It's the amount of profit that you take out of the business. Let me emphasize right now that a dividend is not an expense. It is all by itself in its own category, known as a dividend. Knowing these 6 categories is critical to your understanding of accounting. We now talk about the second building block of accounting. Within each of the 6 categories, transactions are further classified into accounts. The asset accounts include cash, building, vehicle, equipment, inventory, and many more. The liability accounts include accounts payable. These are normally what you bought that you will pay off at the end of the month. Typically in business, this is how things are purchased. You also have notes payable. These are your loans. We call them notes payable in accounting because you signed a note promising to pay. These often include interest and are for a longer period of time than accounts payable. Then we have stockholders' equity, we will be using two stockholder equity accounts. It is important to understand their use and the difference between them. Common stock, sometimes called contributed capital, is the amount that you, the owner, has invested in the business. Retained earnings is the amount of your profit, also known as net income, that you have kept in the business. Revenue is your income. Most of it comes from sales, but you may have some other things like interest income. And in some cases, you may want to further define sales. For example, if you are running a restaurant, you may want the system to tell you beverage sales and food sales. Then we have expenses. These are the cost of doing business. The key is breaking them down into the individual categories you need to manage the business and make decisions. Examples include wage expense, rent expense, insurance expense, cost of the goods you sell, interest expense, and many more. And then the final one is dividends. This is the final category, and in it, we just have one account, dividends. I want to say again, a dividend is not an expense. It is a dividend. A dividend is a dividend. Knowing what type of account things are, such as cash is an asset, accounts payable is a liability, etc., is a must learn at this point in the course. Now here's the third block in our foundation of accounting, the accounting formula. This is a cornerstone of accounting. Assets equals liabilities plus equity. I'll say that again. Assets equals liabilities plus equity. Always. Remember, I already said this. A complete set of financial statements consists of 4 reports. 1, the balance sheet. 2, the income statement. 3, the statement of retained earnings. And 4, the statement of cash flow. You need all 4 to get a clear picture of your company, as each one shows it from a separate view. We introduce these statements in Chapter 1, but we go over the balance sheet more detail in Chapter 2, and the income statement in Chapter 3, and the statement of retained earnings in Chapter 4. In this course, we only touch on the statement of cash flow briefly at the end of the course in Chapter 12. Accounting majors will get more of that one in future accounting courses. Now, I know we are getting ahead of ourselves, but at this point, I want to take a look at a set of simplified financial statements just to give you a first-time visual impression and also to show you how the 4 of them interrelate. Be advised, I have oversimplified them at this stage of the course. We will go over each of them in more detail as we move through the course. The balance sheet is for a point in time. Remember that. It is a snapshot of a point in time. For example, it could be for the year ending December 31st. The other 3 financial statements, the income statement, the statement of retained earnings, and the statement of cash flow, are for a period of time. For example, they could be for the year ending December 31st, whatever year it is. Sometimes they are shown for a month ending, for the month of January, or a quarter ending, the quarter ending March 31st. When the financial statements are prepared, the first one prepared is the income statement, because we need to know what the net income is, as that number is then used to prepare the statement of retained earnings, which is the second statement prepared. Net income per the income statement is shown on the statement of retained earnings. Once the statement of retained earnings is prepared, we now know what the ending retained earnings is, and we need that number for preparing the balance sheet. The balance sheet is the third financial statement prepared. Ending retained earnings per the statement of retained earnings is what is shown on the balance sheet. The fourth and final statement is the statement of cash flow. On this one, we need to ensure that cash per the balance sheet is what the ending cash is on the statement of cash flow. Remember, the balance sheet is for a point in time. It is a snapshot of your assets, liabilities, and equity on a specific day, like as of December 31st, 2001X. One last thing, and this is more terminology. In accounting, the accounting rules are known as the Generally Accepted Accounting Principles, GAAP, GAAP. These are standards that are followed to ensure that financial statements are useful and consistent. The abbreviation GAAP is often used. We will say, these financial statements are in accordance with GAAP. That means the financial statements follow the generally accepted accounting principles.